It's 5 o'clock Mountain Time, and it's time for Tom and Shane Business and Politics. And today we're going to talk about, can you bank on your bank? Can you bank on your bank? We've had bank failures all over the place lately, so we're going to talk about that today. And we should bring you up to speed a little bit on a couple of the banks that have failed. Uh, Silicon Valley is the biggest bank that failed, and they're kind of an anomaly. They're a strange bank. The majority of their holdings are with tech companies, and some of their holdings are in startup tech companies, which is not a good risk for a bank to do a startup tech company because. If the company goes south, you've got a bunch of laptops, and that's about it. There isn't much you could do with those with those assets. You might have some office furniture and a small place. Many people might even be working out of their homes, so you really don't have much to cash in on, like you would a house or a business building or something like that. So, in the case of these banks, and several banks don't particularly like deposits from tech banks because they're not too stable. At least some of the early ones aren't. So there's no loans going out of the bank. So they buy treasuries from the U.S. to replace the loans that they're making. And the problem with Silicon Valley was that they bought these treasuries to shore themselves up, and the feds raised the interest rates. And so they're sitting there with a bunch of treasuries that are paying 2% while you can buy treasuries online or anywhere else for 4%. So nobody wants their low cost asset. And as a result, these tech companies, when the COVID came along and they started laying off these employees and all of that, they started taking the money out of the bank, and that was the big failure for Silicon Valley. And we just heard today that Barclays Bank is the was or not Barclays, sorry, getting ahead of myself here. Republic Bank, Bank of America, Citigroup, J.P. Morgan, Chase, Wells Fargo are all depositing $5 billion into First Republic. Goldman Sachs and Morgan Stanley are going to deposit $2.5 billion each into First Republic Bank. And what that does, actually, there's going to be 11 banks that are going to bail these guys out. And again, they're one of the banks that have put all their eggs in one basket. And when the folks come and want their money, when some of these banks fail, then they find themselves in real trouble. So that's part of the problem that's going on. With the other bank, Signature Bank, they had a lot of their money in cryptos. So you've got the the Bankman Fried deal going on. So that caused them a serious problem because as people started taking their money out of there to invest in other places, then they had an issue as well. Now, who's going to bail these banks out? Well, the FDIC will. Now, they're saying no taxpayer dollars will be spent doing this. Well, what's going to happen is that the FDIC is going to charge more of the member banks more money, put more into your FDIC. And if you think that's not going to be passed on to the bank depositors in the way of fees and other things, that the bank processes for you. It could be could be things like cashier's checks. It could be overdraft fees if you don't keep enough in your account. So all these things are going to come to pass. And so, yeah, the taxpayers will be paying something for that. So there's no question that these banks are in trouble. And the other problem was the Dodd-Frank situation. Um, uh, Southern or Silicon Valley was is a bank of 50 billion, and under the old Dodd-Frank bill, banks that were 50 billion had to routinely report to the banking commissions about um, their risk assessment. They had to make a risk assessment to the banking commission every so often. Well, under the Trump administration, they raised that to 250 billion because of the 2009 collapse of everything. The too big to fail banks. So any bank making 250 billion or having 250 billion in assets would make these risk assets. And now that it was raised from 50 million to 250 billion, then the Silicon Valley Bank was no longer required to give risk assessments. And they felt the reason they raised the Dodd-Frank level was because that $50 billion banks wouldn't collapse the economy. They needed to have the big banks stay stable, and the smaller banks could fail without much of a problem in the money situation. So that's where we find ourselves now. Overseas, we've got Credit Suisse. Their shares plummeted to an all-time low of almost 30% after its largest shareholder declined to increase its holdings, and part of that was because I think of the Southern or the I don't know why I keep calling it Southern the Silicon Valley Bank and Signature Bank. But the result of that is what happened is that gold prices climbed over 1%. The highest since February on Wednesday, as a new banking sector crisis sent investors from riskier assets and drove them to gold. And gold gained 1.7% to 1931.30. So the other thing to think about with this Silicon Valley situation is that it's not just the people who were deposited there. It was the people who do business with Silicon Valley customers. So they're not getting paid, or the FDIC has said they're going to bail all these banks out. So, there we are. So we mentioned that earlier, and I think that's what's apparently is going to happen. So that's where we are currently, I guess. And is this going to affect banks overseas? That would be the question that a lot of people are asking themselves. And what about our overseas investments? What about companies that are overseas in the tech that provide things for tech companies or logistics or you name it? What's going to happen with these businesses and these banks? So we're looking at that. So far, we haven't heard a lot about foreign banks being in desperate trouble, not like Silicon Valley and Signature and Republic Bank. But we are going to have to keep an eye on this and see where it's going to go. So yeah, I I can add you to the broadcast, Shane, but you're not there. you're not your camera's not working anyway. So are you there?
I'm here.
All right. Good deal.
It's not
Well,
me. It's not me. It's StreamYard.
okay. Well, whatever it is, you can still talk to us. So what's going on?
Not much. I was just listening to what you were having to say, and it's a pretty good overview of the present situation, which is only getting worse.
Yeah.
The difficulty you have with these banks in Europe, in particular, from the HSBC into Credit Suisse, what you're talking about is that this has been going on for 10, 15 years. Credit Suisse and Swiss in particular.
Credit Suisse.
Yeah, Credit Suisse, whatever.
Got to pronounce it right.
their large investor that they're referencing is from Saudi Arabia, so but the
Mhm.
Bank of Switzerland is going to put up 50 billion for them apparently
Yeah. So,
to help them. But they've been involved in a lot of
mhm.
situations of investigations and different types of problems that they've had. People have been fined and even sent to jail. I mean,
Mhm.
they have, it's a big bank. I mean, these aren't tiny banks. It's like your big five in
Mhm.
the United States, but across the board, they're all down. I mean, uh, you've got Deutsche Bank is down in Germany. You have Barclays is down in England. It's trading at
Mhm.
675 basically. Lloyd's of
Mhm.
London is down. I mean, it's trading around $2.20,
Yeah. That's not
and
good there.
yeah. So, and one of the problems that of
Mhm.
course they have is the LIBOR rate, which is the lending rate
Mhm.
overnight for between banks. And
Mhm.
this week it's at 5.7. Well, that's where it was.
Mhm.
Back in 2008, 2009,
Yeah.
and it's set in London, and it's the rate that banks lend each other money overnight to operate. And who can afford to pay 5% on money you borrow overnight? I mean, you borrow 100 million overnight.
Yeah.
That's $5 million in interest you're paying. So I mean,
Mhm.
it's one of these established problems that exist now within the banking groups. PNB of Paribas of France, same thing.
Mhm.
That you're looking at an incredible bank, and its stock is holding up because it's better managed. It's $52, but you just
Mhm.
don't know how credible that is, and so I mean, you look at the Credit Agricole Group, in France, and it's at $10. So
Mhm.
all these global banks now find themselves in basically a historic lows.
Mhm.
So this situation is evolving, and it's still evolving in your country because it's not top tier. It's secondary banks. Most of
Yeah.
them are listed on the over counter exchange. They're not even listed on major exchanges. So
Yeah. Yeah, that's the issue. Yeah, their assets are low, but, some of these, the tentacles that go out from these banks affect so many businesses and things that, it's a lot more serious than it seems, but it seems like, both in Europe and in, the United States, they're gonna bail these banks out, quickly and, not bring them back online. They're out of business, but they're gonna make sure the depositors are whole.
well, to some degree, the FDIC was set up in 1938 to do that after the
Mhm.
crash
Yeah.
of '29.
Mhm.
The banks basically have paid into a fund. It's a
Yeah.
fee they pay into the fund, and
Mhm.
annually or monthly,
Yeah.
and that's where the money's coming from. But
Mhm.
at the end of the day, it's the depositors, that the people that want their money back, that are paying
Mhm.
for it. They're paying to get their money back.
Yeah.
So it's a
Yeah.
unique situation to prevent a catastrophe. But when you have two, not one, but now two banks that are in serious,
Mhm.
question of surviving,
Mhm. Yeah.
um, which they won't. I mean, everyone's trying to work to take over Silicon Valley, but you're talking about a pretty big situation. Signature Bank is,
Mhm.
this is a really strange one because this is
Mhm.
it's a public company,
Mhm.
and it trades over the counter. But I mean, it's not. It's got 40 private clients
Mhm.
offices throughout New York and Connecticut.
Yeah.
It's a private bank, so they don't have thousands or tens of thousands of people in the bank.
Mhm.
And it's
Yeah.
it was founded in 2001. It's only 21 years old,
Yeah.
and so
Mhm.
here we go, whack. So
Well, it dealt primarily it grew, handling cryptocurrencies that most
yep,
banks wouldn't
that's right.
touch at one time.
That's right.
So they built themselves up doing crypto. And of course, when Freedman Bank went south, That created an issue for them. I'm surprised they weren't before Silicon Valley Bank with that going on, but they weren't. And as I just mentioned earlier, 11 banks are going to bail out First Republic Bank today.
Well, that's
Uh,
what they're telling us, but that,
well,
we
yeah.
don't know what that means exactly.
Well,
You know,
they're
you
putting
know,
up they're depositing 5 billion each, and 2.5 billion for Morgan Stanley and Goldman Sachs. So they're going to put 30 billion into that bank from 11 different banks. So
yeah,
that's what they say they're going to do. So if they do it or not, well, I guess that remains to be seen.
that's right.
Yeah,
Yeah,
but
it's one of these incredibly strange and awkward situations that
mhm,
the banking system finds itself in.
yeah, well, well, the other thing too I mentioned earlier, Shay, you can comment on this, the Dodd Frank thing. They went from 50 billion to where you had to make a risk assessment up to 250 billion, which took Silicon Valley Bank out of that equation. They
Hmm.
didn't have to do any risk assessment any longer. So that was part of the issue too.
Hmm.
That because they were primarily in tech stocks, and as I mentioned earlier, when all these tech stocks started hemorrhaging people, firing everyone, and they wanted their money to keep, the money they were paying to their employees to put that into research and development, then all these companies started coming after their money, and it wasn't there.
That's right, and it's a strange reality, Silicon Bank in particular, because they locked everybody up. You know, I always kept separate accounts. I kept my personal accounts at a bank, a separate
Hmm.
bank from my business
Yeah,
accounts,
me too.
and I raised my children to understand the difference and why.
Hmm.
There's two reasons why. One, because of something like this,
Yeah.
to keep the Chinese wall, but also to keep a Chinese wall from the banks knowing what you do have.
Hmm.
So if you just bank at one bank, which Silicon Valley required everybody to do this,
Yeah.
that were venture capitally funded
Hmm.
startups, then all the employees, their mortgages or their car leases or car loans, whatever, they knew exactly what they were spending and how much money they had. Whether it was an actual value from salary or it was the result of stock that they own.
Hmm.
So when you find yourself in a situation where you're so restricted by the bank that you're dealing with, it becomes a bit of a difficult um, situation to participate in. But
Yeah.
they were forced to do it. Now they have nothing. I mean,
Yeah.
it's not just about whether or not these companies survive, which we're talking somewhere around 2 to 300 startup companies,
Hmm.
150 companies waiting to go public.
Yeah.
Now they've spent millions, to go through that process, to get
Hmm.
listed in the SEC and be underwritten and so forth. So I mean, this is serious. This isn't just an incident. That we're talking probably 500,000 or 500 to 600,000 people, being dislocated, unemployed,
Hmm. Yeah.
based on the people directly involved and then indirectly involved. So mortgages, cars, I
Hmm.
mean, all kinds, credit cards. I mean, this is a serious whack, and so
Yeah.
it's not being represented well by the market. The market, I think, is misrepresenting it. I think that they're going. The more they shout, "We've put the fire out," the
Yeah.
more you have to be concerned that it's still burning.
Yeah.
Like
Yeah.
it's in the rafters, it's in the roof.
You're putting it out with a can of gas is what you're doing with it.
Well, that's right, and
Well, the other thing too, Shane, you got to think about is that these startup companies, that's where the cell phone came from. That's where apps came from. That's where a lot of the computer programs come from. And without these companies being able to move forward, boy, technology is going to take a real hit in the nuts here in the next few years if this thing doesn't pan itself out, where these startups can maintain their growth and keep innovating.
Well, it's also a matter of the venture capitalists themselves.
True.
I mean, the major banks, sat back and made billions of dollars, billions
Mhm.
in the last
Yeah.
20
Mhm.
years with low interest rates. So we've sort of tried to prepare people for 2 years and certainly a year, and
Mhm.
certainly since
True.
last
Yeah.
October and December. When we warned them for 3 months, get out, get out. Uh, all
Mhm.
you have to do is look at these growth companies, which is what they're referenced to, the FANG
Sure.
stocks,
Yeah.
Facebook, Google, and
Mm.
so forth, to realize, how huge this is. Now, granted, both of Google and was Google and Facebook, right? No, not Facebook. It was Alphabet.
Mhm.
Google.
Yeah.
They split their stock 10-for-1, if you recall last summer. We talked
Right.
about that,
Yeah, we did.
and that this was a danger sign because the capital flowed on it, meaning the number of shares outstanding, and certainly the number of shares on the street created a huge short opportunity.
Mhm.
And I was watching an interview, with the fellow that called the mortgage-backed securities play and made huge money because he figured out how to and got Goldman Sachs to set up a
Mhm.
short on it.
Mhm.
And anyway, long story short, he with us was warning people a year ago, and then of course last fall and into the winter. So
Yeah.
it's all now come to pass, and now how bad is it going to get, and how bad will it be?
Yeah.
I think it continues to get worse. The economy is not doing well.
Yeah.
None of these companies are going to have good earnings or sales. I'm talking
Yeah.
about Facebook and
Mhm.
Google and Amazon. Amazon split their stock too. That was the
Yeah.
other one, ten
Yeah.
for
So
one.
yeah, these companies are looking at a tough summer, I think, Shane. Well, one of the things you pointed out a million times is that money is chicken; it runs where it's safe.
That's right.
And that's what's happening right now. I think companies say, "Hey, I want my money. I want to put it somewhere else." As I mentioned earlier, the credit squeeze put a bunch of forced people to go into gold temporarily, I guess, or as a hedge. That went up to nearly 2,000. So yeah, these companies are looking around for what's safe. What's safe to put
That's
my
right.
money, and under the mattress, it looks like the only safe place for the moment.
Well, you'll know that this is really getting bad when you start seeing silver move. It hasn't yet.
Yeah, that's
So right
true.
now, I'm just giving everyone fair warning. We always recommend a great website called Trading Economics, and the
Right.
amount of information you can get there
Mhm.
for
Yeah,
stock quotes and commodities and
true.
everything
Yeah.
is on one site.
Mhm.
But if you once you see silver start moving, then
Mhm.
you know the trend is going to probably be higher on gold. Right now, as you say, a lot of
Mhm.
people are moving into gold as a hedge because there's
Mhm.
there's really this bond issue, which has been forced on everyone by the Fed because they wanted to sell $4 trillion
Yeah,
in bonds
yeah,
in from their account.
yeah.
And so
And
a lot of banks,
who's gonna buy those now that we're looking at
well,
this banking situation?
that's right, because a lot of these banks said, okay, we will help out. And they started accumulating them.
But they
And
say if we buy these bonds and the Fed raises rates, then they're devalued.
well, that's right. That's called the inversion, and this is
Yeah,
what caused the Silicon Valley situation to
yeah,
fall
that's
apart so
that's where
quickly.
they went. Yeah, they went
That's
into
right. They
treasuries and they got a bunch of cheap treasuries nobody will buy.
not only they won't buy, but they went down in price,
Well, that's what I mean.
and
Yeah, why buy a depreciating asset?
the face value went down in
Yeah.
price. And this happened 30 years or 40 years ago when there was this big issue of of economists coming out of MIT and in
Mhm.
the 90s um, about gold. There's no reason to really own gold.
Yeah.
Banks basically had 10%. People people the old portfolio was 10, 30,
Yeah.
uh,
I think we
or,
recommend 5 or
60.
less,
Well, it
2
was
to 2
10,
to 5.
10, 30, 60. 60 is in equities,
Mhm.
30 in debt or you
Mhm.
know, uh,
Mhm.
bonds or whatever, government
Yeah.
bonds or corporate
Yeah.
bonds, and 10 and then 10%, 5 to 10% in gold.
Yeah.
But into the beginning of the 21st century, everyone dove out of gold basically as
Mhm.
even something to hold.
Oh, it was
Um,
supposed to go to 5,000 back in 2005 when we were first talking about it, Shane.
that's right.
And
Mhm.
it's never got above 2,000, I don't think, or if it did, it might
No.
have only been for a day or part of a day, but it's at 1931 now. I haven't
Yeah,
looked at what it is this very second, but when I checked it yesterday when I was putting the show together, it was right at 2,900 and change.
that's correct.
Yeah.
And that's more of a hedge with
Yeah.
regards to the market,
Mhm.
because of what you're seeing in the market and
Yeah.
these continuous sways because that's what happens in a bear market.
Mhm.
This up and down of the exchanges in your country, the Dow, the S&P 500, and
Yeah.
so forth.
Mhm.
This is a reflection of a bear market. The bears go, stocks go down. They've shorted, then
Mhm.
they go in and buy the stocks to cover their short because they're just trading it on a day or a week.
Yeah.
You see the market move up 200 or 300 points, and then they turn around and they short again,
Yeah.
and then so they're already short on stocks like Amazon and Facebook and so forth because
Mhm.
that's where they're at with it,
Yeah.
and the short positions on those stocks that we know aren't very large. They're 1 to 5% of the float or the free trading stock, but there's a lot of people that are short stocks in the
Mhm.
market around the world that
Yeah.
don't report. So it's that invariably that when you have a stock, you know um, now like Microsoft with 6 billion shares, 6 billion. That's a
Yeah, I
lot of
know. That's a
stock.
lot of shares.
So 100 million may not seem like a big short, but it is if you've got this constant ebb and flow of a
Mhm.
bear market, and this
Yeah.
is why it's a good conversation to have, especially with what's happened not just in the United States, but then it sort of it moves over to, well, we should be looking at Europe. Well, where have these bubbleheads been?
Yeah.
Where have all the
Mhm.
people on CNBC recommending stocks to buy and sell, crazy
Yeah.
money. I'm not going to use the proper name, but crazy money,
Mhm.
and
Yeah.
never talked about the European banks or global banks and the serious problems they have and that they're in.
Yeah.
The British just announced a new budget yesterday, and of course it's in a real tailspin with regard to its economy,
Yeah.
because not just COVID, but now because of this banking issue. So, boy, it's not just you, it's not just me. We're all in this together.
Yes, we are. Well, for the benefit of some of our listeners and viewers, shorting a stock simply means that some people bet the stock will go up, others bet it will go down, and if you bet correctly, you win. So that's what
That's
we.
right.
Some people bet that stocks are going to implode,
That's
and
right.
you can make money doing it. So look it up online. It's a dangerous thing to do, folks. I'll tell you.
Well, we've had this now four times. Four
Yeah.
times. This is the fourth
Hmm.
time in 20 years, 23
Yeah.
years.
Yeah.
Well, 25. If you remember back in 98 and you were around, all the ads on television for .com companies that were brand
Oh yeah.
new. I
Uh-huh.
mean,
Yeah.
they had that one medical ad where they're in an operating room and the doctor is operating on a guy and my God, look at this. He's just full of money,
Yeah,
I mean, they were ridiculous ads for companies that were
they were.
generating
Yeah.
no income, but were
Mhm.
valued, at several
Yeah.
$100 million back then.
Well, you can go all the way
And
back to Yahoo when it was $400 a share. I
that's
mean,
right.
back
I
during the
mean,
Clinton administration. I mean,
that's right.
that bubble burst, and
You have
much like
98,
yeah,
99, the dot-com burst, and then
yeah,
you had the 2001 because of 9/11 burst,
hmm
and that, that the 2002, 2001, 2002, that took me out,
yeah,
and because I was an all-inner, I believed in our countries, and
yeah,
so I stayed with the flow, and I got whacked.
yeah,
Anyway, then you had the 2008 issue that came along, and
hmm
right in the middle of a presidential campaign,
yeah,
and here we are, 20 years later with the same event.
yeah.
So it's quite odd that the general public is unaware of it. But here's the problem: the market now has lost a generation. They've lost the millennials.
Yeah.
We 72 million baby boomers, 74 millennials million, and so they're not in the market. They're
Yeah.
not going to buy stock. So
No, they're not.
this isn't a 1 or 2 year issue. This could take a decade.
Yeah.
Really, this could take a decade.
Like I said,
Uh,
most people working might their investment might be a 401k or a profit sharing at work, and that's it.
Well, that's right. In 86, 87, the Japanese market was buying the world, and the Japanese Nike or Nike, whichever, went to 36,000. Well, it's never recovered.
Yeah.
It
Yeah.
collapsed, and they ended up selling everything they bought everywhere.
Yeah.
And the 5,000 a square foot downtown Tokyo property value, dropped to 500 from 5,000.
Mhm.
And
Mm.
so if this is what you're faced with, and you could come back, and you do have the economy to do that, but not with the government restrictions or taxes and all these this debt that's
Mhm.
been created. This becomes a whole nother issue. So it's good that
Yeah.
we talk about it, Thomas, because people need to
Mhm.
be made aware of it.
Well, that's true. One of the great things Trump did, hey, if you're going to bring me a regulation, get rid of two others, before
Mhm.
I'll go for this one.
That's
So,
correct.
yeah.
And it's a hands off thought of saying that,
Mhm.
but it was hands on for him because
Yeah,
he was adamant about picking the regulations he wanted taken down.
that's true. Yeah.
So he didn't go for some
Mhm. Yeah.
you can't cross a railroad with your like in Montana you can't cross a railroad track with your herd of cattle with a train coming, right?
That's
Like
true. Yeah.
it's against the
Not a good
law, right?
idea. Yeah. That would be it. So, all right, we're running out of time
All right,
here.
buddy. Yeah.
We need to remind you the award-winning Tom and Shane. We're live on radio every Saturday, 8 to 11 a.m. Mountain Time. Listen to us anywhere in the world at kmmsam.com. It's absolutely free. Nothing to join. No sign up needed, no email, no personal information of any kind. You can text us. You can call us. You can call in and voice your opinion. And all of our all of our top past shows also are at kmmsam.com. So you can click over there. You can get our videos and our radio shows as well. And those are absolutely free. Nothing to join, nothing to do anything with. And we need to, of course, remind you that we are here every Tuesday and Thursday, right, Shane?
That's
At
right.
5 o'clock Mountain Time every Tuesday and Thursday. Tom and Shane, Business and Politics. We are here, like it or not. In spite of cards, letters, and phone calls, we are here. We enjoy being here with you guys. So, all right. Well, we couldn't see Shane, but he's still half man, half amazing. He still put great information out. So, thanks, Shane, for bearing with the problems and everything that we had to put up with here. And Linda says, great show. Thank you, gentlemen. We appreciate you very much, Linda. Thanks for
Thank you,
joining us.
Linda.
And thanks for all the folks that join us every time we're on. and we really appreciate that very much. So, all right, that's going to do it for us. Thanks for watching. Don't forget to subscribe, ring the notification bell. You'll always be notified when we're on, no matter what time zone you're in. Like us, leave a comment. If you like this kind of content, let us know. We'd like to hear about it. So we'll hear you on the radio on Saturday, 8 to 11 Mountain Time, kmmsam.com, and we'll see you next Tuesday for our next podcast. Bye for now.